On Wednesday morning, investors will get the latest print on Consumer Price Index for June. CPI data is expected to show a continued slowdown in inflation pressures. Wall Street expects headline inflation rose 3.1% annually last month, a slowdown from the 4% rise seen in May. On a core basis, which strips out food and energy prices, CPI is expected to rise 5% over last year in June. That's a slowdown from the 5.3% increase seen in May. Here to weigh in, we've got Peter Tchir, who is the head of macro strategy over at Academy Securities. Peter, great to have you here with us this morning to really kind of kick off some of this inflation data that is set to come this week and the expectations that perhaps some of the inflation pressures are continuing to ease here. So where and what particularly in the data would you be looking out most closely for?
I think we are going to see sticky inflation be the problem. We're seeing goods inflation generally come down. I think that continues. I think supply chains are no longer a big issue. So look for some, relief there in auto prices, things like that. And we'll see what happens really in hospitality inflation and service inflation, right? I think there's signs that could start slowing. It's probably not going to happen this. And the reality is I'm hunkering down for a 3 to 5% inflation prints for the next, 6 months to 2 years. I think it's going to be very difficult to get it below 3%. It's not going to go back above 5% anytime soon. And that's what's going to allow the Fed to be very slow playing on this data. So it's not going to be as important each individual print as it was in the past, as the Fed is now on a very level playing field, I think.
At the same time, if you're expecting, Peter, the inflation numbers to stay 3 to 5%, that's still above 2%, which is the Fed's target. So do you think we're actually only going to get a couple more increases? Do you think we're maybe even actually lowballing the number of hikes that remain?
No, I think we'll get this one in July, and maybe we get one in September, one in October if we stay above that 3%. But I think they're going to be one, they say 2%. I think they can't change their official rate. I think behind the scenes, they're somewhat comfortable with 3%. And they're also going to want to be very careful about hiking too much into an election year, right? You can go back to what happened to George Bush Sr., where he had these great approval ratings, then the economy tanked, and his, renomination or reelection failed. So I think they're going to be really careful. They're going to stick to this. Hey, we've hiked a lot already. Let's see how this plays out in the economy. There's signs of easing. There's signs of pressure of the economy. So let's just keep it stable. So I think maybe we get one more hike after the July. And I do not think, though, we get any cuts at all.
At what point in the kind of inflation prints that are set to come over the course of the Fed's continued policy here, where Fed Chair Jay Powell has already said that we could still be looking at consecutive rate hikes at future meetings now, at what point would it be clear within the data that we're looking through that they are able to achieve perhaps a soft landing that they've continued to talk about?
I think if we see this kind of slowing of the inflationary pressure, which we've generally seen, it's going to go up and down a little bit, but this trend is a little bit better. And I think there's just enough data points offsetting, right? If we start getting where every single bit of data looks weak, or every bit of data looks strong, we're going to have to offset that. Again, the jobs number itself was weak, but average hour earnings were high. So there's just enough, I think, to keep them on hold. And it would really need consistent data that's extremely high or extremely low to change that kind of baseline they've set for us.
If we are going to see these two increases and then sort of have that status quo, right, and persistent inflation, what does that setup look like for equities?
I think really it comes down to equities. Good news is going to be good news. Bad news is going to be bad news. The Fed's not going to be manipulating or influencing markets quite as much. So I think earnings are going to be even more important this season than they've been last season or any other time recently. It's going to come down to individual stories, how companies are doing. And we're going to start watching, I think, more and more, how is the U.S. consumer doing? I think the consumer has been the strong point that's been the shining light in the economy. There are some signs that it's been weakening a little bit. You're seeing delinquencies tick up, not alarming rates, but higher. Credit card usage is going up. We don't know what's going to happen to spending once you start seeing consumers people having to spend their money on their student loans. So I think the consumer is going to be a big focal point for driving the economy as well.
You mentioned something really interesting. I was going to ask a totally different question, but the second you mentioned student loans, I don't know, my blood started boiling as a person that still holds a significant amount here, Peter. So that considered, we've heard some calls on the street talking about where student loans have a broader economic impact once those resumes. Perhaps you could flesh that out again, just a little bit more here for us.
So I think the impact's not going to be as great. I think one thing that happened is a lot of people, whether it's on the loan front or on their mortgages, anyone who had these deferrals, I think they did a good job of setting money aside in their bank accounts knowing eventually these payments were going to come out. So what I'm really looking for is excess savings to come down a little bit further and more rapidly as people start spending that money to meet their obligations. So I don't think it's going to be a shock. I don't think we're going to hit like this, brick wall in terms of consumer spending. I think it's going to be a minor slowdown. I think people were prepared for it, a little bit disappointed. And maybe what you're seeing right now in the travel and leisure is that one last gas. Hey, we've got the extra money. Let's spend it now because we're going to have less going down the road. So I feel it's like a headwind, only a small headwind, and definitely not going to be something that shocks the economy.